So tonight, this is part 2 of the Opportunity Zone Meetup, and we're going to be talking about starting an Opportunity Zone Fund and how we go about doing that. And in this part, we're going to focus on structures. So as many of you know, the 2017 tax bill created the Opportunity Zone tax incentives. And the 3 primary incentives are the deferral of capital gains, reduction of those capital gains, and then a waiver of taxes if there's appreciation in that investment and it's held for a minimum of 10 years. Right now, you're seeing a lot of people going, you gotta hurry, you're gonna lose all these tax benefits by the end of 2019, you gotta have everything in place by 2019. And the fact of the matter is that this reduction, the second benefit, means that you have to, if you hold the investment for 5 years, you get a 10% reduction. If you hold it for 7 years, you get a 15% reduction in your current capital gains tax liability. So we actually have till the end of this year to get the full benefit, which is the 15% combined aggregate between these two. But if you miss the end of the year, you still have another 2 years to get your project in motion and get the 10% deduction. And in this, relative to the total investment, is the upside potential of no taxes on the appreciation in the investment at the end of 10 years. So we're going to see projects go out to 2026. So we have technically 7 years to still work with this third and primary benefit that's here. We have till the end of this year to get the full maximum optimal thing, but it's only 5% of your tax liabilities it now stands. And not that that's inconsequential, but in a small dollar raise, it actually almost isn't a big deal. And we still have 2 years after that. So that's why I'm thinking that we're going to see businesses pick up the pace now that we got new rules. And communities still, in my mind, will have till the end of 2021 to get a project together, get this benefit to their investors, and still shoot at the major benefit at the end of term. So these are what we got to do. Now, in order to gain these benefits, an investor, which is a person who's what's called a qualified investor, has to have a capital gain, as it's defined by the IRS. That money, capital gain, has to be rolled over within 6 months into an Opportunity Zone Fund as a mandatory requirement in order to gain these tax incentives. And with this rollover, then that fund has to deploy that money within another 6 months after that. But that's not going to be the key problem here, is that everybody's having timing issues getting money into a fund within their 6 months, and the fund being prepared to deploy that money to assure that they don't miss their deployment date and all these tax incentives roll backwards. And there may even be penalties associated with this because they may have gotten a deferral and now they're going to have to recognize that they didn't actually get the deferral. So those all things happen. So the thing here we're talking about is this first step is the money has to be rolled into a fund. The fund has to be set up in the manner required by the Treasury regulations of the IRS, and we're going to spend time talking about that as a structure. For tonight's program, I'm going to be using this live project, the Sugar Beet District Opportunity Zone Fund Corporation, as an example. And there's a lot of things that we're doing in this project that other people will not do. There will be differences that we're going to explore between your particular project and this one. This one's simply going to serve as an illustration of one way of doing it in a particular type of development. So as I described earlier, the Sugar Beet District project's an intended 50-acre mixed-use project. We're going through a series of stages in our capital stack as we progress. And as soon as we get the first key property locked down under contract, then we can conduct a capital campaign to raise money into a fund. So the way we have set this up is we are going to do a capital campaign investors fall into three potential categories. I'll come back to that more in a moment. But this would then come into the fund. This fund has been registered with the Colorado Secretary of State, so it's set up within the Articles of Incorporation. As it's set up, there is a specific statement as required by the IRS that this is for the purpose of acting as a qualified Opportunity Zone fund to enable tax incentives. So that part has been completed. There is also associated with that all the usual things of setting up a new corporate entity in which we will have bylaws to govern day-to-day operations. We'll have the minutes, which allocates the stock and elects the board of directors. Then the board of directors will take the first preliminary steps towards operation of the company. Now, in this case, the money will come into the fund. The fund will be essentially a passive pass-through type of entity, and it is going to serve no other purpose. So the actual operation of the fund will be contracted out to NZ Development, LLC, which will provide all the services, all the activities, all the stuff that the fund has to do. We'll get into that in more detail. And at the same time, NZ Development is going to manage NetZero Colorado as an asset company. And there are a variety of reasons for doing it in this fashion. So the money will come in, and 100% of it will go directly into this asset company for moving forward. So we've got 1, 2, 3, 4 different entities all working together, hopefully in high harmony, because this is a dedicated purpose, single fund that is to facilitate this happening, and all these documents are being created by us for our own use, so they should all sync up neatly. That's the theory, anyway. To give you a better idea of how this will work, NZ Development, the management company, initially will have a contract to manage the fund, and it will receive for that service 1 share of common voting stock. And this has been set up with the Secretary of State, so there's only 1 share authorized of common voting stock, and there's 10 million authorized of common non-voting stock as the initial capital structure. So then at the same time, NZ Development is going to manage the asset company. So it's going to receive 25.5 million shares of ownership of common voting in the asset company, the Oz business. And as the investors come in, they're going to buy 8.5 million shares of the fund at $1 a share, common non-voting. So this 1 share has more voting power than all 8.5 million here. These will not have voting rights. And then this money will be rolled into NetZero Colorado, giving 8.5 million shares of common non-voting by the fund in NetZero, which will be a 25% equity position in the profits and losses of NetZero. So that brings us to the first question. When you're doing an Opportunity Zone fund, you have 2 options. One is for it to be administrative, which is the style that we're using for the Sugar Beet District Project Fund. It's solely there to move the money through. It's solely there to assure that we meet the qualifications to gain the tax incentives, and it's going to be there to file all the forms every 6 months with the IRS for the next 10 years or until the exit is completed. So as simple of a model as we can, because we don't want any infrastructure, we don't want any cost associated with this, none of that gains us anything. This is here as a required legal entity, and it's purely administrative in nature. Now what you can do is you can have the money come into the fund, and the fund be the operating company. It can invest directly into a property. It can roll, manage the property development. It can do everything from here. But in this case, then this was going to need a business plan and all the usual attributes you see in a development company, because that's the role that the fund is playing. It's not only bringing the money in, but it's actually managing the property from this standpoint. So if you're trying to do an ultimately simple thing, you might say, well, it would be better to make this an operational company, but there's a reason why you probably won't. As has been described, and I haven't read thoroughly the new rule release, so this is my first admission, and you'll hear this several more times tonight. If you put the money into a fund, the fund has 6 months in which to deploy that. If it deploys it directly into property, it's got to do that within the 6 months. If it puts that money into a qualified opportunity zone business, that business has up to 30 months in which to deploy the money. And in a real estate development where you're waiting on permits and other owners and all kinds of things that are not within your control, 30 months gives you immense flexibility to get everything done. Now, if it turns out you've got everything lined up and everything's under your control and you've already got all your permits and everything's in hand, you might still want to then have your money sit in a fund that acts as the operator or the manager of the property development. And you'll have to look at whether that truly simplifies life because you don't need to make it any more complex by creating one more entity, which is holding the asset and acting as that, or in our case, we created 2 more entities. One is the asset holder and one is the manager of the assets as an outside company. So, but this is kind of the first question that came up working backwards is, are you going to pass the money through, or are you going to hold the money and work with the money within the scope of the fund? Second question is, are you going to generate just capital gains, or are you also going to potentially generate ordinary income by the operation of whatever you're doing with the money? Because if there's ordinary income taking place, it's going to be taxed every year just like any other type of activity. So if you have property and you're collecting rents, those rents are going to be treated as ordinary income. They're going to have to be taxed every year going out. And that is a question then that comes up as you're trying to figure out how to position the fund and investors in the fund to get the maximum return on their investment. What kind of income are you dealing with? There are certain large projects that they're going to put the money in. There's no defined ordinary income, and the only time they're going to have is a capital gain at the time that they exit the fund and take their money back. Those are going to be fairly rare projects, but they can exist. And a lot of the early commentary was all focused around a single event, put the money in, wait 10 years, take your exit, and very, very simple. But it requires an unusual project that it's not going to generate any ordinary income during the life of the 10 years. Yeah, Ty.
Talk about the 10 years. That's from formation of the fund to exit. So if you formed the fund, you're still waiting 30 months. If you're spending 30 months to get your business off the ground, then in fact the full investment period is going to end up being less. I mean, right?
The 10 years is from when the investor actually makes their investment into the fund.
Right, not to when the
not from when the money's deployed.
Yeah. Okay.
Right.
Okay.
Yeah. So from their standpoint, the investor's going, has my 10-year clock ticked by, and at that point, no matter how far the project is advanced or developed or whatever it happens to be, on the deployment side, yes, we have other clocks to watch, but for the 10-year time period, the minimum is going to be 10 years and a day. Then they can come out and get the maximum benefits from an opportunity zone investment. What you see, and this will come up a little bit later in the investment section, is everybody's going, well, there seems to be an assumption we're going to jump out of the 10 years in a day. But that may not be your best choice, and the investors may not want that to happen. And they may have an option to stay longer to the maximum of 2046, or come out sometime in between, or play the market when the market peaks and then decide they want to come out. So that's a later issue we're not going to talk about here, but we do want to understand, what kind of ordinary income may be generated in their 10-year life, because it's going to impact some of our choices here and how we go about doing this.
So if you actually have a rental property, for instance, but the money goes back to the management company, is there any way to change that into not? Okay, I wouldn't think so, but.
Well, we're going to talk about it on the next slide, so let me jump forward to this. One of the things you may look at is you have ordinary income coming into the business, whatever that happens to be, or the property. You're going to pay taxes on that, and if it's in a corporate structure, the remainder is still with the business. So you're creating a cash asset that is building within the business. You may reinvest that within the framework of the business, which drives up the value of the property over time. In our current modeling for the Sugar Beet District, we have not gone to that next step of rolling the money over. We're just, for business planning, simple planning, we're just creating a reservoir of cash that's sitting there for the purpose of buying out investors at the end of the 10 years. Whereas if you have a pass-through entity of some kind, you may say, well, we're going to distribute 100% of the ordinary income out to our investors, which means it's not in the business any longer. Its ability for the business to use that and build the value is going to be diminished. It may not make any difference, depends on what you're doing. We're looking at some solar panels and you're going, yeah, it wouldn't make any difference because you're not going to put up more solar panels or do other things in that framework. So it really wouldn't change your role here. This would be a non-decision in the design. But if you have the potential, like we're looking at, we're going to try to pull as much of this into a corporate structure. We're going to pay ordinary income taxes from the corporate structure at corporate rates. And we're going to hold the remainder with the intent of reinvesting anything that's left over after taxes to try to build the value of the asset. And that's just normal good money management. But in looking at your modeling, everybody's going to be different because it's based upon your tax rate, how much cash flow you have, how much cash you need at different points in time for the operation of your business. And so there is no one size fits all here. They're going to all be unique, custom to the investors and to the project and the amount of cash and types of taxes that it's generating. So one of the questions also, well, what will be the control of the fund? As I described the fund that we're setting up for the Sugar Beet District, the investors are going to put in 100% of the money and get 0% of the control. So the idea here is that we're assuming for the moment that the investors are bringing their money of value and nothing else really is going to be of contribution from the investor standpoint. They're going to be looking for a return on investment, even if we're going to get other types of benefits out of the investment beyond cash or distributions of profit. None of the investors are people who we would look to either provide advice, expertise, introductions, or other things you can do with investors that are sometimes more valuable than their money. So again, in this simple model, we're just simply saying we're going to take your money, you don't get to vote because we're going to make all the decisions, and hopefully you're going to be happy with the decisions we make and we achieve our outcomes that we're planning for. But it could be done differently. And this is one of the things where if the investors come in and you give them control, say everybody that invested got common stock, immediately the management of this company would be under the majority ownership by the investors. And if the investors decided to change their mind, scope a project, whether to gain maximum tax benefit and other things, they might legitimately decide we're in a 10-year project and 3 years in, this doesn't make any sense to us. We want to call it a day. We want to cash out and go home. And they have the ability to force the fund to sell the asset because they're still in a management position. They got the majority control. So this is something, again, to look at where if it's a small, single purpose, single person type of a thing, I'm all the one person, you're wearing every hat, doesn't really matter. But where we have a lot of money involved and people with different agendas or different outcomes, having this potential insurrection that could occur and disrupt the entire business model to the detriment of the other investors becomes a problem. So we kind of locked the vault shut on this one because we didn't want anybody to say, I want out, in a manner that would cause potential harm to the other investors in the fund. So one of the other things then is once you've raised money into the fund, and not before. And when I say raise money into the fund, hitting your minimum goal, then it's the right time to file your Form 8996 with the IRS and declare I am an Opportunity Zone fund, so that they can then start monitoring your behavior with regard to filing of the semi-annual reports. You can file before you've raised the money, but you've just basically invited them to ask for information that's incomplete, which may never actually be realized. And so it's a timing issue on when you file that. The form is very, very simple. It says, we're doing this, this is the date, here's where we're at, and it goes in. Now, once it goes in, you have until June 30th or December 31st to file your semi-annual report, and that's when they're going to ask for the name of your investors, how much money, and all these other things. And this is going to get into a obligation or duty, a function of management that we'll talk about in the next section. But for purposes of getting certified, you do a filing. There's no merit review. There's no other thing that takes place. But we did get in a discussion on one item, which is that I wanted a mailing address that was inside of an opportunity zone. And in a greenfield development, we had no office that we could put up on the zone. And so we got a post office box at the local UPS that's in the opportunity zone, which is our current temporary address until we get something that's more definitive.
Is there a requirement to have a mailing address inside the opportunity?
There isn't, but I didn't want to send in a form to the IRS for fear that even a simple automatic review of the thing would kick back and go, you just filed to be a fund and you're not in the zone. And I didn't want to go through any of that conversation. It's not clear. This is one of those classical, I'll call it, filing issues where everybody understands what you're supposed to be doing, but if you give them an invitation to take a lot of your time and explain something they don't understand, that's time lost. So we're just trying to avoid that little thing.
So is it in the same zone as your opportunity zone?
It actually is.
Oh.
You can technically file in any zone. There's no requirement that your investment be in the same location as your office, as long as they're both in opportunity zone areas. And there will be certain projects and certain funds that'll come out doing multiple projects in different opportunity zones, and there's a number of them I'm talking to now that are going to have that issue. But what became more and more clear as you look at this rule and this filing and how they go about it, it really is not a good idea to mix assets in a single investment using one fund to do multiple assets. And you certainly don't want to mix multiple investors from different groups. So we were talking about maybe having one fund and doing different raises within under the same umbrella. Because anything that messes up a single investment could then spill over and contaminate everybody else. You would be better off setting up multiple companies, each one a single fund, and if we got money in from one of our partners on this project, we would go ahead and do a separate entity, separate fund, take that money in and reduce the amount we're going to raise through this offering within this fund. Crossing them over seems to be a potential, because if anything goes wrong, it could negatively impact everybody who's an investor.
You're talking about different funds then?
Different funds, yeah, even on the same project. So we could end up theoretically with 2, 3, or 4 funds just to get this project rolling, all taking out different parts of this. We could end up with one for each property. We could continue to break this down into smaller and smaller pieces so that we end up with something that is very modular but all contained. And if one piece blows up, it won't necessarily blow up all the rest of them. A lot of talk still out there by a lot of the large wealth management groups about how they're going to have these multi-project funds or multi-asset funds. And I really, that seems like a potential nightmare waiting to happen. And there's been a lot of backing off from that. Most of the commentary recently is one fund, one purpose, and even breaking it down as we may break this down into multiple funds for specific purposes within a large project of this size. Okay, any other questions on structure? We're going to talk about management, responsibilities, functions in a moment, and then after that we're going to talk about handling the investment and running a capital campaign at a administrative level. We're not going to get into the depth of going out and soliciting or framing who the investors are. That's probably going to be our next program in a couple weeks to get into that. Yeah, Ross?
For your sugar beet project, the Qualified Opportunity Fund, what structure did you use for that?
We used a corporation.
And what election did you make on that?
Election
In terms of the tax treatment?
as a corporation.
As corporate.
Yeah, because in this sense, as we said, the active operating company will be NetZero Colorado. It's going to be generating revenue hopefully within 3 to 4 years, not counting other activities that we may get into. And so the current projection is the last 7 years of the 10 years, it'll be generating ordinary income from rents from the tenants. And we wanted that money to come into a public benefit corporation and then hold as much of that asset there so we can reuse that asset after taxes, after payment of ordinary income taxes, to try to build the value of the entire project. And we have lots of programs that we can put that into within the structure. If we were to do it as an LLC there and then again in the fund, those ordinary income would pass all the way to the individual investor. And in some cases, that's the best choice. And the investors may dictate that or want that as a structure. So if you don't know who your investors are, common practice is go do surveys, talk to your people, make sure you're clear on what they want and what you want, so that as you're putting this together, you don't have to unravel it or start over again. Because we often tell people the structure is the last thing you should do after you've got everything else pretty much lined out, whether you've got soft or hard commitments throughout the entire process, because something may change that dictates it from a tax standpoint, cash flow standpoint, or investor requirement, and the investor is writing the check. So if you need that money to come in, you want to make sure they're happy. Yeah.
When you registered the S corporation with the Secretary of State,
Not an S corp, regular corp.
Sorry, regular corp. Sorry. Is there a requirement that you state the purpose in that public registration, or is that something that's contained in the articles involved?
So the question is, when you file with the Secretary of State, the IRS rules set out in Form 8996 says that you have to specifically state that this entity was created for the purpose of being an Opportunity Zone Fund. So in online application in the state of Colorado, there is a line where you get to state what is the purpose of this entity. And that's where you put the line in. So one of the things to help you out with is that after the program, in the guide that's going to be distributed in a PDF format, you will also get copies of these documents. So you'll see the actual thing we filed with the Secretary of State and the wording that was used there to make it clear that this is for the purpose to conform to the requirements of the IRS.
So there's a real risk that somebody would not state that as the purpose and effectively disqualify the fund.
To me, I don't view the failure to make that statement in the document as a fatal error. It's something where if somebody called you on it and said you didn't make that statement there, you can go back and amend the Articles of Incorporation and make it workable. And as long as nobody's been misled or there's no other type of issue, that's just an administrative change and it can be done after the fact. But if you came up for a review in the context of something else went wrong, I would not want to have that as another problem that I would have to deal with, because somebody from the IRS may use that against you because of the fact that you were sloppy in your filing.
And then for NetZero Colorado PBC, what structure did you use there?
We're using a public benefit corporation under Colorado Corporate Code. So this particular entity was created to take advantage of the hybrid entity under Colorado Corporate Code called a public benefit corporation. it requires transparency of information so that all of your investors have access, on a regular periodic basis to everything. And it also has to address a social good. Now, I helped pass that legislation 3 or 4 years ago, and we used a very generic definition of what is a social good. We did not raise it up to the level of a B Corp standard, which requires people, planet, profit to work together in harmony. We could basically just help people or help planet or do something with the profit that would be for the benefit of the community, and that would be sufficient to meet the Colorado definition of a public benefit corporation.
And then were you able to track the ordinary income in the PBC structure?
From tax standpoint, a public benefit corporation is taxed just like a C corporation.
Okay. And so you are going to track the income?
Yes, it is our intent, as I indicated earlier, that we're going to pay ordinary income tax as it's earned by the public benefit corporation, and then the remainder of the earnings after taxes will be left in the entity for reinvestment into other activities and projects, or even other real estate. We can do whatever we want to with that money once it's been through the loop, and it doesn't have to be inside the Opportunity Zone. Once we've earned that money, we can spend that outside of the zone unless it's somehow going to affect the definition of this as an Opportunity Zone business. But yes, you'll get all these documents will be included, and this basically will, this is the documents filed with the Secretary of State. These are fairly generic bylaws, nothing particularly new or special there. The minutes determine that initially there'll be one shareholder, which is the development company, and it'll be issued 1 share of common voting stock. And then we'll have a board set up which overlaps the development company and the asset company. So we're going to talk about conflicts of interest later. And then once funding is received, then this document would have to be filed with the IRS to self-certify. Okay, that concludes part 1 or 2 of tonight's program.